Hi, good morning, and welcome to the weekly Strategic Insight live call. Before we bring David on, I do want to go over just a few housekeeping items. You'll see on your bar below your screen, you'll have a little Q&A bubble. Please submit your questions, and we'll be sure to follow up by email, get in touch with you today, and answer your questions. We're not sure because time is tight that we'll get to any live Q&A today. There's so much information that's coming out so quickly. We do want to get all of this information out to all of you as fast as possible. So if you will use the little Q&A bubble, type them in, we'll be sure to follow up with every single one that we have. You are always also free to email request@waddellandassociates.com with any questions or your wealth strategist. Second, you see on the screen in front of you, Waddell. If you would text that to 44222, that will opt you into an email list where we will be sending any updates we have to the materials that are covered on this call. With that, I'm going to let David jump right in.
Hello, everybody. Good morning. Thank you for clicking in. I'm certain that many of you are at home practicing the social distancing that's been requested of all of us, which is a really good idea. And so by now you've probably finished the Netflix or you finished the internet. And so you may or may not have bandwidth for 40 minutes of my thoughts on where we are. But hopefully you will. You know, normally I've got a lot more time to sort of prepare for a presentation like this. And so we've got a lot of slides that just came out of the paint shop. If you locate an error or if I flub a quote, please give me a little bit of grace as this has been quite a week. But I want you to understand that this isn't going to be a pessimistic call. There is no cause for alarm. Obviously, we are facing some significant challenges, but for any of you who were nervous and thought, uh-oh, Waddell's doing this live feed because something is amiss, that's not the case. You know, we have a little game we play around here, and we've given each other sort of superhero names, and I am known in the office as the Fog Cutter. So this is my attempt to cut through all of this noise and cut through this fog and tell you where I think we really are in terms of the health crisis, where we are in terms of the economic crisis, where we are in terms of the market and financial crisis. And much has happened in these few short months in 2020. And I spent, like I always do, 1,000 hours thinking about what the year was going to look like pre-corona. And so I'll walk you through the initial outlook for the year, just to hold myself accountable, and then I'll walk you through the revisions now that we've got a little bit of new information. If I can advance the slides. I may have to do it manually. We're all learning this on the fly. Interesting. Heck help. I have so many slides. Okay, so I'm going to do it manually. Here, take that. That's not working either. Yeah, we are. All right, disclosure. Read that. Now it's working? Okay, thank you. All right, so as we walked into 2020, my expectations were that we would have a very dynamic year, but somewhat boring when you looked at the math. Sort of expected that we'd see 2% GDP growth, which, by the way, is sort of our standard and potential GDP growth as a country. Inflation seemed benign at 2%. Interest rates were following the path of inflation, which is what they do. Valuations at 22 were a little high, but relative to the level of inflation and interest rates, they weren't really all that lofty. When you looked at earnings, the expectations were, after a dead year last year of earnings across the S&P 500, which is an easy data set to mine, that we'd see maybe 20% growth over the next 2 years, which would be pretty optimistic for the market. And seeing as that'd be optimistic for the market, that would be optimistic for Trump's re-elections. By the way, please don't read into this any political stance. I am not pro-Trump. I am not con-Trump for the purposes of this. I am just a man who makes predictions. So based upon that, it looked like the world was pretty sanguine. It'd be an okay year. We had World War III that tried to knock us off early in the year. And then obviously we had the coronavirus spin up. And because of that, things have changed. So I'm revising this 2020 outlook, but I'll give you the punchline as we move towards the end. First and foremost, we do have a coronavirus afoot, but this is not something new. It's a novel virus, but it's not a novel idea. So we have dealt with pandemics of significant size going back, thousands of years, and we've gotten better at dealing with them as we've gone on. What you see in this chart is an accounting of the biggest pandemics that we've dealt with going back to 1900. And I'm sure you've read about these, you've heard about these, but the Spanish flu was particularly deadly, and we're going to talk in length about each of these back in 1919, 1920. Then we had the Asian flu in 1957. We had the Hong Kong flu, which showed up, about a year after that. And then we recently, although you've probably forgotten it, dealt with the swine flu back in 2009. So while these pandemics are scary, we have some experience that we can draw on to do some analysis. So here's, as far as comparable to the coronavirus, the worst case scenario for the coronavirus would be a repeat of the Spanish flu. This is not our base case. Back then, we had no antidote, we had no vaccine, and we dealt with 3 rounds of surges of deaths per thousands, which is what this chart shows you. The other thing this chart shows you is that these viruses do tend to die off in the summer. They don't like humidity, they don't like heat. Maybe the safest place in the world is Memphis, Tennessee or Houston, Texas, because those are the hottest, most humid places I've ever been. Nonetheless, let's do the math. Back in 1918, 1919, we had 500 million cases of Spanish flu, according to the CDC. We had 1.8 billion people on the planet at the time, so it was a pretty high contagion rate. The deaths that resulted from that were substantial. 50 million people worldwide died. In the US, and I'm going to focus a little bit more on the US, in the US, we had 30 million people contract the disease. We had 108 million residents at the time. And the death rate was very high, again, because we had no medical solution for it, at 675,000 people. So from a health perspective, it was pretty darn serious. From an economic perspective, it was somewhat serious. Anecdotally, I was able to pull some newspaper clippings from that period of time, and I found one from Little Rock. And basically what it says is Little Rock merchants as their business have declined 40%. That's pretty much in line with some of the language I'm hearing. Others say the disease caused a 70% shutdown in revenue. The retail grocery business, I think, did well to begin with, kind of like what we're seeing now, and then people were afraid to congregate, and so those numbers came down. And so they sort of quipped, the only business that's doing well right now within Little Rock are drugstores. So it was a pandemic. It also had quarantine, and it did have business implications as well. Well, here's what happened with the stock market, and forgive me while I fiddle with the technology. Still think we're doing a pretty good job on this. By the way, the reason I'm standing is because every one of these I'm on, the person who's presenting is sitting, and I end up looking up their nostrils. So hopefully this is more appealing to you. The Fed went back and did a whole bunch of research on the economic consequences of that 1919 pandemic, and they summed it up this way. Most of the evidence indicates that the economic effects at that time period were relatively short term. Many businesses, obviously those in consumer service and entertainment industry, suffered double-digit losses over the time period. But other businesses, those that sold mattresses because they told you to go home, go to bed, did well. Healthcare products did well. This is per the St. Louis Fed. So I went back and pulled the data on the Dow to try and figure out the impact there. And it's difficult to get a lot of data, but there is data on the stock market going back to 1896, which is helpful. Over the entire time period, let's recall that we were also mired in World War I at the time. The Dow Jones Industrial Average actually gained over the Spanish flu duration about 50%. There was a max drawdown of about 11% that occurred as those fatality rates spiked, like I showed you in the previous slide. But there really wasn't a GDP drawdown over the entire period. I've seen some reporting that there was a recession in 1919. They capped it at 7 months. The average recession is 13 months. So even if there was a recession during this time period, it was relatively benign. Also, remember, the country was really focused on the war effort, and the war machine was cranking out. So you had a big offset in terms of perhaps a stimulus, which we'll talk about later, that ended up helping to boost the economy. All right. Here's the best case scenario of the pandemics I studied. It's the swine flu. This occurred back in 2009, 2010. I don't know how much of this you guys recall, but this was super contagious. There were 1 billion cases worldwide. We were probably 7 billion people at the time. The worldwide deaths, however, were only, and only is a word that I use mathematically, every soul matters, but 363,000 people lost their lives due to complications from the swine flu. And in terms of the US, we had 61 million cases of swine flu, right? So there are 330 million of us, which means several who are on this call probably had the swine flu, whether it was diagnosed or not. In terms of the US, we had 12,500 deaths roughly due to complications from the swine flu. And so medically, it was very significant, very contagious, but not very deadly. In terms of what happened within the market, the Dow over the time period, as I'm showing you in this chart, was up 40%. The gray bar to the left of your screen indicates that we were in recession as the flu started up, and that was obviously a contributor. Again, the macro environment matters a lot that we overlay these flus upon. So GDP growth over the time period was positive by 4%, and we had no GDP drawdowns. We had just come out of the Great Recession, and so we had a head full of steam coming out. All right, here's a second place finisher in terms of my comparisons, and that's the Hong Kong flu that occurred back in 1968, 1969. There's not a ton of data on this, but it was a significant event. So worldwide, there were probably 625 million people that contracted this disease. The worldwide death toll was pretty high. 1 million people lost their lives because of the Hong Kong flu. US cases, again, this was very contagious and it was a big deal. 62 million people contracted the disease, and of those, there were about 100,000 that died. It was a bigger deal in Asia. There were 500,000 people in Hong Kong who actually caught the disease, and I pulled this little gem from the South China Morning Post, which is a great newspaper, by the way, in Hong Kong. And they said even the whales are catching the Hong Kong flu. So it was in the public consciousness worldwide. It was a pandemic. There were a couple of waves, and that's what I'm showing in the chart. I couldn't find a chart that depicted what happened in the US, but I did find one from the UK. So take these numbers and move them to the left a little bit on the timeline. And you'll see there was a first wave that was somewhat benign, and then there was a second wave that was more serious, and it shows you where the threshold is for average epidemic. So there was a big spike. It was a one-time spike, really. The first wave was not all of that concerning. In terms of the drawdown in the marketplace, it did impact the stock market. There was a 7% decline near the case spikes or the death spikes in the US. But overall, during the time period, the market was down 3.4%. What the market was really dealing with is the fact that the guns and butter campaign under LBJ left us an inflationary environment. We were linked to the gold standard. We came off of that in 71. There was a big recession sort of in advance of that. Not big, but a meaningful recession in 1970, sort of the Nixon recession, I suppose. So the market tailed off at the end of this chart and ended up going down in 1970, but that was really in reaction to an economic climate, not a healthcare climate. So if you're seeing reports on that, I think those are wrong. In terms of GDP growth, like I said, it did slow over the period, but we never did print a negative quarter. There was, as I said, a slight recession in 1970. I think it was unrelated. So the Hong Kong flu did have health consequences. It really didn't have tremendous market or economic consequences. Which brings me to the best fit comparison. I want you all, as you think about the coronavirus and try and figure out where we are, to get in a time machine and go back to 1957 and 1958. This is the appropriate analog. There were 625 million cases of this worldwide, similar to the Hong Kong flu. Worldwide deaths also similar, 1,100,000 people lost their lives. In the US, probably 65 million contracted the disease. And there were deaths in the US of 116,000. We did go through quarantines. We did go through closures. It did have an economic impact. You can see that there were two waves. What was kind of odd about this one is most of the flus do end up perishing in the summer months due to the heat. This flu survived to a certain extent the summer months. The red line is the average number of expected flu season fatalities. And so you can see we did have a couple waves, one in November that was most meaningful, and then a repeat back in March. So very difficult period for the country. There was a health crisis. There was also a bear market. So if you look at the left side, you'll see that the Dow, although it was successful over the course of the entire period, there was a 21% price decline. And when you throw the dividends back in, the market was down 18.26 from the high, coincident again with sort of the increase in fatalities. In terms of GDP growth, there was a recession. So what happened with the Asian flu is we had a health crisis, we had an economic crisis, we had a market crisis, and that's what makes this the appropriate analog. In Q1 1958, we did go into a hard stop in the economy, just like the one that we're experiencing today. That was the right thing to do from a healthcare perspective, but it did take a toll on business owners. I have not been able to go back and get the data. I've got somebody working on it right now for me to see if there were any stimulus responses during that period, but I'll sort of footnote this and I'll get back to you all to see if there were any fiscal stimulus responses. But GDP growth did fall in the first quarter of 1958 by a quarter-over-quarter annualized rate of 10%. Okay, that's a big deal. And consumer spending was down significantly. After 1955, there have only been 4 quarters where consumer spending was negative. This was one of them. There were 2 in the great financial crisis, and there was 1 in that recession in 1970 that was rather slight. It definitely took a toll on restaurateurs, on the travel industry, et cetera. This is an appropriate analog. But what you can see is the economy snapped back quickly once the virus, fatality rate began to fall. So we did have a bear market, we did have a recession, we did have a healthcare crisis. That makes it the best fit as a comparison to what we're dealing with today. So let's bring this current. We have a virus, we are going to have a recession. So far, the Dow has fallen 28% on the year. The max drawdown was about 32%. That's the fastest decline we've seen in history. I'll show you some more on that. Why is it declining? Well, earnings are going to be impacted. We will see a hard stop. Businesses are shutting down, which is correct. The more that we can sort of self-quarantine and take our extended spring breaks, the less likely it is for this disease to proliferate. It'll bring the health curve down, as you know. It'll reduce sort of the demand shock on the healthcare system. And so self-quarantine is the right thing to do, but it is going to have a GDP impact. So I thought this was a pretty good slide. Goldman Sachs put it together. They said, look, there are going to be some winners. So the healthcare industry could actually see a 15% gain because of this. They don't want to, but thank God they're on the job. So they could boost GDP 1% or 2%, hospitals, outpatient care. Those who are in sports and entertainment obviously are suffering significantly. That could detract a bit. Near total cancellations and package tours. Everything that was on my calendar for the next 3 months has been scrubbed. In terms of major hits, obviously transportation is a major hit. You see what's going on with the airlines and the request for a $50 billion bailout. We do need them. The structure of that bailout is what they're arguing about. Casino gambling, obviously that gets hit, pure discretionary spend. And then obviously hotels and restaurants, car rentals, domestic services, all of that stuff takes a pretty big hit, probably a 50% hit during the time period. And then goods, ex food. I can kind of go through all of this. But what you see is the biggest drawdowns end up being in consumer discretionary spending, right? If you're in the toilet paper business, it's a good time. If you're in the business of selling high-end, home theater equipment, it's probably not a good time. So that gives you perspective maybe on which industries get hit the hardest. You may know this already. All right. The market has taken this and obviously declined about 30% very quickly, which is just astounding. It's amazing to me how fast things move these days. What does matter is the aggregate decline. For those of you who are watching the market on a daily basis and trying to figure out what's going on, please stop. It is not you and I moving the markets around. This is Godzilla versus King Kong sitting at their laptops and moving things around with machines. And the more volatility there is, the more opportunity there is for them. So traders are going to trade, they're going to battle. We don't want to get involved in that at all. In fact, in a traditional Godzilla movie-like scene, we need to be the people on the street getting out of the way, but grabbing a TV every once in a while that's on offer. So market's down 27, 30% really so far. That puts us right at the average for a recession and a little bit below for post-war recession. There are going to be those of you on this call who believe, and I'm sympathetic to it, that we're going to have a Great Depression, that this is going to cause a Great Depression, or at a minimum, cause the same sort of declines and disruption that we saw in the Great Financial Crisis. So if that's the case, then we're about halfway to the bottom, or if you go back to the Great Depression, we're about a third of the way to the bottom. So for those looking for the dire scenarios, there are your dire scenarios. I am not in the camp that this is going to occur. Now, one thing you can say is, David, this has been a really long economic advance, and so we were sort of overdue for an event like this. Now, many of you may know that we got very nervous about a natural cyclical recession last July, and in fact, we put hedges on the portfolio. The Fed stepped in, the Fed printed $1 trillion, they fed it to the markets, and the markets rose to new highs into February, if you can believe that. But there weren't really any structural problems in the economy. We just thought they were making a policy mistake. So we reduced the hedge. We still had a hedge on going into this year because we wanted the economy to prove itself. But our forecast was that things were actually improving. And so we were turning more bullish as the coronavirus smacked us. This slide matters, right? For those of you who say, all right, we've been in economic advance for a historic period of time, you're right. We're now in recession, so it was about 128 months of unfettered advances in the economy. That is a record, but it's by no means the strongest economic recovery in history for the US. In fact, if you look at it, GDP from trough to peak now went up 26%, which pales in comparison to the 43% we did in the 90s, 38% we did in the 80s, how about 52% in the 60s, and then 29% in the 50s. So although it was a very long economic advance, it was not a strong economic advance, and things weren't really that overblown. In fact, after the financial crisis, consumers did a lot to repair their balance sheets. You're hearing a lot about corporate credit levels going up. That's true, but you also have to remember that interest rates came down a lot. So it's the cost of servicing that debt that really matters to corporations. And there were people in the fringes and the excesses. There was a bubble in private equity, I think. We didn't participate. There was a bubble in private debt that's being unwound right now. Good for people in the distressed business, but not a systematic issue the way the decline in housing prices was on the mortgage industry. So while there were spots of the economy that were perhaps concerning, overall the economy was just not overblown as we entered into the corona crisis. Now, forecasts are coming down, and so this is fluid. There have been 3 cuts at this. I'm using Goldman's data. The first one said, look, you know, coronavirus is a threat, so maybe the first quarter growth is lame. Second quarter could be closer to 0, and then we should recover back to trend. Well, every time, I don't have a third click on this chart, I will, but every time they revise the second quarter lower, they revise the third quarter higher, they revise the fourth quarter higher, they revised Q1 higher in 2021, they revised Q2 higher in 2021. So my point is, every time you get one of these reports, and they were out overnight, somebody said, well, first quarter GDP or second quarter GDP is going to decline quarter over quarter by 25%. That's possible. But what they don't tell you is that not only did they take those estimates down, but they took the subsequent estimates up, right? So the V shape is present in all of these reports. You're just not hearing about the other side. What does that mean for earnings? Well, this is what they had currently projected for earnings, and you can see what I'm talking about. Here's the pattern, right? So we had great earnings growth in 2018 thanks to the Trump tax cuts. We had lame earnings growth in 2019 because of the trade wars and other issues. 2020, we expected to see good earnings growth. We were disrupted by the coronavirus, and now everybody's quickly taking estimates down. So first quarter estimates are coming down, second quarter estimates are coming down, but then you get into the fourth quarter and you start seeing the expectations of a rebound. And then the growth in earnings gets pretty substantial going into 2021. So again, the street is forecasting gloom and doom correctly, in my judgment, for the second quarter, but also forecasting subsequent recoveries. Now, several of you may be on the call saying, but David, it's really different this time, right? Because this isn't just the financial crisis like we had in 2008 that morphed into an economic crisis. We also have a healthcare crisis. So this is the worst hat trick imaginable. We have a health crisis, we have a financial crisis, we have a market and economic crisis. Okay, so let's take a look at each one of those. First of all, to inoculate us from the financial crisis, we have a Federal Reserve that learned a lot in 2008. I mean, I remember, obviously going through that time period, and every day there was a new package coming to market, whether it was TALF. I mean, they were doing all sorts of things. I can't even remember all the acronyms, but they do. There's institutional memory. So they dealt with financial crisis they hadn't seen since the Great Depression, and it forced them to innovate on the fly. We are seeing the fruits of that now. So they cut rates to 0, 2 swift cuts. That was a good move. They also basically told the market, look, we'll print however much money you want, right? So there's unlimited liquidity. The facilities that were done today were in the hundreds of billions of dollars. They're already in the money markets. They've been in the commercial paper markets. The Fed is totally on the job. What I can tell you is there are things to worry about right now. I'm feeling pretty comfortable that we are not going to have a financial crisis because of what's going on with the coronavirus. The Fed is on the job. They're doing it correctly. They have inoculated us against a financial crisis. Crisis 2, an economic crisis. So if I'm Trump, and I'm not, but if I were and I was running for re-election, I'd want $1 trillion, I'd want $2 trillion. The economy sort of needs it, and we need to get this to the market as quickly as possible. Now, the devil's in the details, right? There is political friction here, which is super irritating. We saw it again in 2008. Recall that at that time, the Democrats were in control. They wanted to do a big stimulus. The House Republicans voted no, which I was about to go on TV for the BBC, I think, at the moment. And I almost fell out of my chair. They said no? Are you serious? Well, so this may be the comeuppance. Now you have a Republican president, you have a Democratic House, and this is an opportunity for them to maybe make him look bad and maybe win the election. It's political comeuppance. It all comes back around. Hopefully that's not the case, but I'm worried a little bit that the delay is this political game playing. If that is the case, the Democrats will get punished just like the Republicans did. And by the way, they changed their mind 2 days later and passed it. So even if they stymie these efforts are going to work. You are going to see stimulus, whether it's mailbox money, I don't love that, or it's cuts to payroll. There are going to be lots of different structures. There are going to be bailouts. There's going to be all sorts of stuff. Money is on the way. And for those of you who say, what about our debt? We can't afford it. Yes, we can, and here's why. Go look at the Treasury market right now. I think interest rates are at 1%, right? We got down to 0.54, I think, when things got really weird. And I'm talking about the 10-year. Everybody at a time like this wants to be in the dollar, right? And so the best way to be in the dollar is to buy a Treasury bond. There is limitless demand right now because of the crisis for Treasury bonds. So if I'm Trump, I am going $2 trillion at it, whatever it takes to not only buy the vote, but also to correct this divot we're going to see in the economy. And there's limited or limitless demand for treasuries right now, and you can price them at 1%. And by the way, if the market doesn't show up to buy them, the Fed can print money and buy them. So there's plenty of money for stimulus. There's no inflation on the radar screen because this is a deflationary environment. If there's inflation down the road, we'll deal with that when we get to it. The stimulus is going to happen. I don't want to belabor it anymore. But politically, it's just going to be like watching sausage being made. So do I think we're inoculated from the economic crisis? The answer is no. Do I think that the work being done will inoculate us from the financial crisis? The answer is yes. Devil is in the details. So this is a healthcare crisis, right? We can all agree to that. I'm going to do some math. Again, optimistic, pessimistic. I'm in the realistic business, right? This is the news on typical annual flu. So the world population is 7.7, 7.8 billion people right now. Globally, 700 million people contract seasonal flu. 650,000 people on average will die. In the US, we get about 20 to 60 million people a year that catch the flu. Of those, the fatality rate is 0.1%. That's baseline. And in the US, that means 40,000 people on average die of the flu every single year. Common flu. So now you're seeing lots of crazy numbers on the coronavirus. These numbers are a couple of days old, but I think what's most important is this fatality rate number. Seems to be, you know, in China, they started out, it was 3.5%. That's terrifying. Then you get into South Korea, they did the vast majority of the testing per capita, and they came back at sort of a 0.6%, 0.9%. Those numbers vacillate. So as we test more people, the fatality rate will come down. So the alarming fatality rates that you're seeing of 3% plus and crazy numbers like that, those numbers are going to come down. We just don't have all the data yet. And whether we end up testing, you know, millions and millions and millions of Americans, I don't know. These numbers that the CDC puts together rely on testing and then, you know, percentages and estimates. I do not think the fatality rate is going to stay where it is. So therefore, here's my estimate, okay? And this is somewhat risky, but I just want to set realistic expectations. So there's 7.7 billion people on the planet. My guess is, you know, in an average year, you have an 8 to 11% chance of kind of catching the flu. So let's be conservative here, which we do, and say, all right, 15% of the globe's going to catch the flu. What's the fatality rate? Well, let's use the fatality rate from the Asian flu in 57 and 58. The fatality rate, as I calculated, especially in the US, was about 0.18%. So let's just be conservative and say that's where we're going to be. US, we've already gone into quarantine, so I'm going to lever our contraction rate down. The fatality rate and the contraction rate in the US tends to be lower because we have the resources, we have the information, we have the medical infrastructure that Africa doesn't have or developing nations don't have. So better health outcomes, at least for something like this in the US. But if you put that all together, 40 million people in the US could get this disease. Okay? That would be on par, by the way, with seasonal flu. In terms of US fatalities, you just have to figure out, you know, what percentage you're going to get in a fatality rate. But this ends up being 2x, 3x, maybe the seasonal flu, if we don't intervene. Okay? So I drove the highway this morning. By the way, it was a ton of fun because nobody was on it. And so I went into Walgreens yesterday. That was weird. I know y'all all having these experiences and you're thinking it is the apocalypse. It is the opposite. It is the antidote, right? So every time you walk in someplace and you think, oh, this is a sign of, the hell, death, and destruction that's occurring out there. No, this is the intervention. So the social distancing is working. The more panicked we get about it, the better the health outcomes will be. So all of this social distancing you're doing is working. So the question is, will the team be effective, and who's on the team? There are 3 ways to battle the coronavirus. One is quarantine. That's what we're doing, by the way. The Waddell and Associates office, as of this morning, is now fully virtual. We are completely and totally online. We have prepared for this. We'll continue to do, commentary like this as necessary, hopefully to calm some of your fears. But we are quarantined. That's the right thing to do, so you should do it too. In terms of an antiviral, here's the question. Do you believe in science? Because the bet on science right now is the right bet. There are 7 billion people in the world who, if they're aware of it or a little bit nervous, that's one of the greatest business opportunities of all time. And do not doubt, we're all benevolent in our own right, the power of the profit motive. So there are lots of people working on this. The governments are going to reduce the regulatory hurdles. There is going to be a solution. And I should say that while 1957 was so severe in that single quarter, they got a vaccine. They got a vaccine to market within 6 to 9 months. And it was only 60% effective, but it did a lot to lift the spirits of the people during that time period. By the way, if any of y'all have stories out there of living through the Asian flu, I would love those. So email me those or call me. I would love some anecdotal information on what that period was like, because I think it's an appropriate analog. But anyway, so we've got an antiviral that's already sort of been developed. The remdesivir, if I got that right, was developed for the Ebola crisis by Gilead, and it is in testing. That thing's going to be out to market in 2 to 6 months. We heard last night that there was something that had been developed for malaria that seems to do a good job at stymieing. So those fatality rates are going to come down. They're going to come down. And then the question is, what about the vaccine side? So you can defeat these viruses through quarantine, antivirals, or vaccines. Moderna is working on that. It's already in human systems. And so we should see that, I would guess, within 12 months. And those that were in first are also coming out first. So this curve below shows you the active cases, total active, right? So you subtract the deaths, you subtract the recoveries, and you can see the curve is bent lower in China. The curve in South Korea is bending lower. Even the rate of ascent in some of the other nations like Italy, et cetera, is starting to slow as the quarantines take effect. So there's already evidence, at least, that the healthcare team is being successful against this disease. And by the way, they always have been. So this is a market chart, that maybe doesn't give you a lot of comfort within a 5-minute sort of gnat attention span. But if you blow things out a little bit and say, okay, human ingenuity is unstoppable, right? And so we had an Asian flu that, again, I think is the best analog in the 60s. You had the Hong Kong flu, you had smallpox, you've had swine flu, you had Zika, you had Ebola, you had MERS, you had SARS, you had all of these things, and yet the line starts low on the left-hand side and rises high on the right-hand side because of human ingenuity and our strong instinct to survive, which is what's kicked in right now. So here's the news. I don't think that the power of 2 is going to thrive in 2020. I think we're now in the power of 1. So, although I will say, if I look at it over a 2-year time period, I'm sticking with my power of 2 call. I'm just extending the cycle. If we end up having 1% GDP growth this year, then we have 3% next year, right? But I think it's 1, if not 0, depending on how long it takes for all this stuff to kick in. In terms of inflation, there's no inflation. In terms of interest rates, they're going to stay low. It'll be interesting to see what happens when all that treasury supply comes to market. But my guess is with a low inflationary environment and with yields anchored around the globe, we'll continue to see very low interest rates. In terms of valuations, trailing PEs tend to decline about 20% or so during recessions, okay? We topped out at 22 or so. And according to the data I saw this morning, we were at 16. So a lot of damage has been done, right? Earnings haven't changed, but we've taken 30% out of the market. That's basically a 30% drawdown in valuations. My guess is that drifts a little higher. So maybe we get to 18 by the end of the year. The analyst community, although they've slashed their estimates for 2020, again, tend to see earnings growth in 2021, maybe around 11%. Now, as far as the political side of this, I have no idea, right? If Trump executes on massive stimulus, if we all get through this, then he's a wartime president. He can wave a flag somewhere. So maybe he wins. If they're successful at, not doing any stimulus or stopping stimulus, then maybe he doesn't. I don't really know. I just left this in there because I just don't really know. So assume for the moment that we do get stimulus, we do avert an economic crisis, maybe Trump gets reelected. I don't know. All right, here's my bottom line, okay? And I'm using numbers here, and this is why. There's a difference between probabilities and possibilities. I live in a world of probabilities. How do you determine probabilities? You do as much research as you possibly can. You take into account everything that you can in the present situation, and you try and determine what's most probable. It is a mistake in our business to try and think about what's possible. What's possible? Well, it's possible that we all get the disease and we all fade away. It's possible that we go into a Great Depression. It's possible that the Democrats, cooked up the coronavirus. It's possible that the Chinese gave it to us so they could kill us all off. These things are possible, I suppose, and fun to talk about or not, but they're not probable. We live in the probable. And the most probable scenario for us looks like what we experienced in 1957. So let's talk about it. Again, it was a global deadly pandemic. 1 million people lost their lives. That's a big deal, but it was 0.03% of the entire population. In terms of the bear market, we had a bear market. It was inspired by a hard stop in consumption. The Dow fell 21%. The hard stop in consumption took that quarter-over-quarter US GDP growth rate down 10%. We had a negative print on consumer spending in the first quarter of 1958. Here's what's really important. The market bottomed in the fourth quarter of 1957. Okay? So the markets are discounting mechanisms, and they are going to find a floor in advance of the economy finding a floor. That's an interesting factoid. All right, so where are we now? Let's make the analog. So the globe is 2 times the number of people that it was in 1957. And so we'll just extrapolate forward and say that puts 0.03% of the population at risk. That's 2 million souls. It's terrifying and it's tragic, but it's in line with what we saw in 1957. In terms of the bear market, we've already drawn down 33% on the Dow Jones Industrial Average from the top, not year to date, from the top. I do think we have a hard stop recession. Frankly, the harder it is, the better off, sadly, the health outcomes will be. The inoculation to the disease may be a recession. That's the medicine we have to take. Then it's up to the politicians to backfill that economic activity so that we can all make payroll. I'm a small business too, right? This is a time of significant duress, but we're equipped to get through it. For those who don't have the financial wherewithal to get through it, there are going to be emergency lines that come from the government. It's incumbent upon you now to figure out how to access those emergency lines. So one of the other things that we're doing right now is I want to be the oracle of how to access the stimulus so that our business owner clients can get an answer hopefully quickly, because it's very difficult to try and get this information on your own among all the misinformation on the internet. So we will have some resources available call us, and we can talk to you about how to get the stimulus on offer. But if you're a small business person, let me just vamp on this for a second. Number one, if you had appropriate financial planning, then you would have stockpiled some cash in advance of this, because we told you the cycle is going to end at some point. So let's just start preparing. Let's reduce, if possible, the illiquid assets. Let's take leverage down where we can. Let's start sort of husbanding resources to get prepared for what eventually will come. Weren't sounding the alarm, just might as well be prepared. Well, now here we are. So you've got whatever cash you got. You got to access your lines of credit. If you can get lines of credit right now, and you may, because we're not in a financial crisis, then get them and pull some down on them so that the banks can't take them away. Sadly, you've got to manage your expenses. Non-critical travel and non-critical marketing, although I don't think you should shrink from marketing, maybe just figure out how to make it more cost effective. So there are things obviously that you can do within your P&L to trim expenses. Refinance, right? Interest rates are low at historic low levels. And if you can refinance, then you'll free up some cash. And then lastly, it's not available yet. They did sign one bill. We're sorting through that. There maybe is some relief for you in that first bill that came out of the House that Trump signed last night at 10 o'clock, the previous night at 10 o'clock. I can't remember. Previous night at 10 o'clock? Yeah, a night ago. Gosh, it's been a long time since then. So there is stimulus coming. There's some on offer. It's not really directed at the employer. It's directed at the employee, but that's something else you can access. If these are things you'd like to have conversations about, you have questions about, call us. We'll help you. All right, so that's what to do as a business owner. So there's a hard stop recession coming. Now, if that hard stop recession is Q2 2020, and I feel quite certain it is, then if we're back in the time machine in 1957, then the market bottoms in advance, which would put the bottom somewhere around here. Where are we in terms of the global inoculations? Financial crisis, we're good. We are not going to have a financial crisis. The banks are in a good position. The Fed is on the job. They recognize that they've got a blank check to spend money. So I feel good about what we're seeing out of the Fed. In terms of the economic crisis, I'm giving us a half check here because the intent is there. The bazookas are loaded. Every time Trump goes to the podium, he uses the T word, trillion, which is where we need to be in terms of scale. We just got to figure out how to get it out the door. And I think Mnuchin's meeting with the Senate today, and it's a bipartisan panel, so maybe we're getting something done there. But there will be economic stimulus. Ain't there yet. This gets a half check. In terms of the health crisis, we're not there yet, right? We're doing the right things by social distancing. We've got vaccines in trial. We've got antivirals in trial. But as of right now, we don't have the solution, so I can't give that a check. Now, these things will all be checked. I do feel confident of that. And again, if you hear the dire economic scenarios out there, look past their Q1 estimates, or their Q2 estimates, even their Q3 estimates, and ask them, really, what's your expectation for 2021? And what you'll see is pretty V-shaped returns. So let's go back and look at 57. By the end of the year, and this is Ibbotson data, large cap stocks were down 11% on the year in 1957. Small cap stocks suffer more, and we've written about this because they don't have access to the credit lines that the large companies do. They don't have, as Apple does, $200 billion worth of cash on the balance sheet. And so they're living a little bit more hand to mouth. They're a little bit more economically sensitive. Often they're retailers, et cetera. So small caps will suffer more during an economic crisis. And they did in 1957 by the tune of, call it 150% of what large caps did. Look at 58. Also not something people are talking about. Large caps were up 44%. Small caps were up 65% in 1958. Let's bring it current. Large cap stocks are down 27% as of 2 days ago, I think. Small cap stocks are down 41%. Fortunately, the hedge that we've held within portfolios was calibrated towards small cap stocks, and that has helped offset some of that drawdown. But if you've got assets here or elsewhere, you're feeling the pain of this if you had a diversified portfolio. If you didn't have a diversified portfolio and you owned the one stock that went up, congratulations. You're welcome to join our investment committee. But most people are experiencing pain and it's larger maybe than some of the headline numbers because you've got the diversification. So small caps have had a terrible year, but 2021 is a whole new chapter, and based upon history, if the markets have a V, and the economy can have a U, but the markets will have a V, then it portends pretty good returns, I think, in 2021. So it may get worse, but it's certainly going to get better. This is my last slide, and I pulled this 5 minutes before I got onto this call. This is the chart showing every Dow drawdown greater than 30% going back to 1900. Notice anything? Other than the Great Depression, right? And by the way, they messed up policy so bad in the Great Recession, they created an echo recession. They messed up trade policy. They messed up central bank policy. They fumbled fiscal policy. I mean, it was the Keystone Cops. I don't think that's where we are. So take the Great Recession off the table for a second, right? We saw a flash crash and a panic back in '87. That was sort of where we are at these levels. Fed didn't intervene. There was some policy response that ended up rebounding. So outside of the Great Recession, what all of these charts have in common is a V-shaped bottom. Now, in 2008, in the fall, Warren Buffett wrote an article in the Wall Street Journal. It was a pretty good read. And he said, hey guys, buy stocks. Remember that? Market rallied. I mean, to have that power. And then we had some policy fumbles, especially in the way we were dealing with the bank bailout. Again, political problems. And we went into a lower low into March 9th of 2009. If you'd have bought when Warren told you to, you would have been miserable by March 9th of 2009. But you know what? 4 months later, you were happy, right? So I don't know if this is the bottom. I don't know. What I do know is that we play the probabilities, and if you look at the probabilities, this isn't the time to sell. This is the time to start increasing risk exposures. And if you're working with a financial planner or a financial advisor, your asset allocation is correct. Also, keep in mind that when you're looking at the market every single day, that's a portion of your net worth. Your house isn't bouncing around to that degree. Your Monet isn't bouncing around to that degree. And so when you calculate the drawdown in your portfolio, and I'm proud of the way we've handled this downturn, but if you calculate the drawdown in your portfolio and you look at that in the context of your entire net worth, it's not as bad as you think it is. And as fast as markets have moved down, you can look at the charts, and especially with the algorithmic trading today, they will at some point quickly rebound higher. Now, I don't know if that's today. I don't know if that's 15% below where we are. But 5 years from now, I feel very good about looking back at this and say that was a buying opportunity, because I believe in the ingenuity of the healthcare industry and the responsiveness. The internet has done damage because there's so much misinformation and it scared us so much. But in reality, that's part of the solution, because it's driven us all into isolation. And that will kill the disease. Either disease kills you or you kill the disease. And if we all sort of self-quarantine, that's what's going to happen. So that is my bottom line. So we did have to revise our forecast for 2020. And these are very challenging times. I do not want to make light of the health risks. They are serious. When you look at the percentages, they're not things that you all need to be terrified of individually, but they are things that we've got to be precautious on. I'm worried about the loading of the healthcare industry. So the more of us that can just self-quarantine, let's just take extended spring breaks for a couple of weeks, the better off we'll be. WNA is alive. WNA is open for business. WNA is working remotely. I want to thank, Kathy and T and all of the people who think a lot about our contingency plan. And I want to thank our marketing group. It's amazing what we were able to pull together this quickly. So Teresa and Lainey's been incredible. She was the one who set this up. It's the whole team has rallied to this. I'm so proud of our people right now. And we are 100% accessible. We've got a no voicemail policy. If you wake up at 2 a.m. and you're freaked out and you want to have a conversation, call us. We're not going to call you at 2 a.m., right? We will respect your time boundaries. But if you want to have a conversation, that's what we're here for, especially at times like this. So that's the probability analysis of where we are, not the possibility analysis. And with that, I will close saying, take care of yourselves, take care of your loved ones, go wash your hands, and we'll get to the summer. And I feel certain we will survive and thrive. Just got to take the precautions to get there. So with that, I'll turn it back over to you, Teresa.
Thank you, David. That was fog cutting as always. We certainly appreciate your outlook. Thank you all for tuning in. For a copy of this presentation, and again, any updates going forward, please text Waddell, W-A-D-D-E-L-L, to 44222, and you do that by entering a new text message. Enter it just like a phone number on your cell phone. Again, Waddell to 44222, and with that, we'll close, and we will follow up with all of the questions that were submitted during David's presentation. Have a good day, everyone.